Hello. Today, in less than 5 minutes, K&G International Advisors will give you a summary of last week's most important international financial news. This week, we are getting technical, but bear with us. It's important. A cautious consensus seemed to have emerged among the market participants that inverted bond yield curves significantly an imminent recession. Should investors be worried about this? First, let's explain what the above actually means. The bond yield curve plots the yield interest rates of bonds with similar credit quality but different maturity dates on a chart. Connecting the dots gives you your yield curve. For example, U.S. Treasury securities, government bonds, all have the same underlying credit risk, the risk that the U.S. government defaults. But there are different maturity available for investors to buy. For example, 2 years, 10 years, 30 years, etc. Plotting these interest rates over time for any type of bond shows how markets are perceiving credit risk and, more broadly, risk in the economy. In normal times, investors demand higher rates for longer maturity bonds. The principle is simple. If you were to lend someone money for 1 year and then lend the same person money for 10 years, you'd want a higher rate for the 10-year loan, as there is a whole 9 more years of risk the person defaults and you don't get your money back. The higher rate compensates you for the higher probability of default over a long period of time. Plotting this in a chart gives you an upward sloping yield curve. If a yield curve inverts, that means that markets want higher rates earlier and lower rates further out. Your yield curve looks more like a hump. Historically, this has been an indication of an upcoming recession. The market wants higher rate up front to protect from the higher risk of default in the short term, and so shorter-term rates rise. In the past 2 weeks, we have seen the U.S. Treasury yield curve inverted, sparking headlines of imminent recession in the financial press. In our view, the rise in 2-year yields is best explained by investors' confusion over how to deal with a situation for which they have no precedent. COVID's impact on the economy and the historic levels that come with this are relatively new. It is likely that investors are late to the party on pricing in higher short-term inflation via higher rates, and that is probably what we're seeing in the short end of the yield curve. The 10-year yield has been held lower than it otherwise would have been by the U.S. Federal Reserve's massive economic intervention in the market. Without this intervention, and assuming the 10-year yield would have been allowed to rise as it normally would we be seeing a yield curve inversion? Probably not. The sources used on today's video were Yahoo Finance, Bloomberg, and Dominion. My name is Juliana Lato from K&G International Advisors, and we wish you an excellent start of the week. Also, we'd like to thank you for watching our video. Don't forget to subscribe to stay updated on all the important financial news, and don't hesitate to contact us if you have any queries or further comments.